So for some insights on where international markets are heading, we speak to Peter Esho, co-founder of Wealthy. Good morning, Peter. Now, the S&P 500 is officially in bull market territory, up 20% from October's lows ahead of next week's FOMC meeting. Is the market telling us that the Fed will pause their rate hikes?
Good morning. It's great to be back with you. I think the market's still confused. I think what we've seen so far this year is a recovery from the sell-off that was end of last year. The market is still trying to understand at what point the Fed peaks and hold, and for how long they hold. And the problem with that is that central banks are data dependent. And the inflation data that's been coming out has been very sticky. It's yet to turn. And it not only has to turn, but it has to show a trend after it turns for central banks to change their tune. So we're somewhat in a holding pattern. Stock markets have recovered from last year's losses, but we're still trading within a range. And I think there isn't much conviction until that inflation shows a peak and a trend that it's coming lower.
So you're not convinced by the recent US jobless claims numbers, which are the highest since October 2021, suggesting that the labor market is starting to show signs of cooling?
No, I don't think that's enough, because if we go back 1 week and a week before that, we saw very strong job growth in the non-farm payroll numbers. The unemployment rate is still sub 4%. And that's still a job market that's too hot to signal that inflation is about to turn. I think we need to think in terms of a 6-month period. We need to see inflation turning, falling for about 3 to 6 months before any central bank pivot. Now, that could happen. That could happen very soon. But I think unless that happens, an initial jobless claims number here, a soft retail number there, these are always going to be treated as one-offs, and I think they're going to be dismissed by the market.
Now, Peter, given that markets have mistimed the end of the hike cycles from central banks, how do you think investors, in particular the larger funds, can position themselves now?
Well, it depends what your mandate is. So if you're a large fund and you're an equities only fund, I think you continue to invest and you try to look for thematics. If you have a look at the S&P and the NASDAQ and the drivers of the recovery, it really has been concentrated. I think if you have a look at other indices like the Russell 2000, there's more of a story there. There's more of a thematic there. And when you start to see that move, it might be an indication that the broader economy, that the stock market's looking through any potential soft or hard landing. So it depends what your investment mandate is. If you're in alternatives, there's a big move now in alternatives from public to private credit. For example, a lot of investors are going in, filling this gap that the banks are kind of walking away from. Now, there's no such thing as a free lunch. That private credit exposure comes with its own risk and its business cycle risk. So I don't think, to answer your question, I don't think in the past 6 months we've seen a change from investors around their mandate. They're not running away from anything in particular and running towards anything. It's status quo and just sit and wait for the business cycle to turn.
So does this mean that tech, and if I use NASDAQ as a reflection of the performance of tech, it's up 26%, albeit it's really concentrated on these 6-7 names, will continue to see inflow from institutional funds and continue to inch up? 26% is quite a rally on a year-to-date basis. I mean, does it still have legs?
Yeah, I think it does. I think tech is a theme that's going to be around for generations. I don't think it's it's a short-term trade. And even though it is concentrated in a handful of names, these names are changing the world. We must remember that it's not just hot money going into businesses for the sake of it. What Nvidia is doing and what Microsoft and Google, Alphabet are doing, these are very significant businesses, and there's going to be very significant cash flows behind that. And they're going to change the world, and they're going to really change the way we live our lives. So I'm a big believer in that. I'm also a big believer in the cryptocurrency ecosystem. We've somewhat forgotten about that because that's been a speculative, asset class that has had a lot of volatility. But the case for crypto continues to grow. And even though a lot of attention has moved on to AI, I actually think that the crypto universe is going through somewhat of a growing up period, somewhat of a maturity period. And that actually makes it more attractive for portfolios. So I'm a big believer in tech. Do I buy anything just on hype? Absolutely not. I think you have to buy on merit, and that's the challenge. To buy on merit in tech, you have to have really good visibility on the future, and you have to understand what businesses are doing today. Just like Amazon in the early 2000s, you had to understand their vision and their path in order to ride that investment successfully.
Can we expand on your point about crypto? I mean, how would you reflect crypto in your portfolio? What's the allocation like?
That's a hard question because as emerging asset classes come out, it takes time to figure out how to invest around them. So it depends who you are. If you're an individual investor or if you're an institutional investor, let's start with the institutions because that's a little bit more of an easier way to answer it. Institutional investors, I think, are still sitting there and thinking about ways to implement exposure. So, a lot of the work that was done over the past couple of years around custody, around governance, I think that hasn't gone away. They know that crypto is going to be an asset class that stays. In terms of an individual investor, I think what's happening is we're moving away from speculation to a little bit more of a diversity and a sensible approach. Instead of riding the coin that's booming and just buying it on speculation, we're now starting to sit back and say, okay, well, the Ethereum ecosystem, let's have a look and see what's being built on top of it. Let's go and have a look and see the businesses and the innovation and the real use cases around that. Bitcoin as a reserve currency, it was laughed at 10 years ago, but today, the US is broke and they continue to increase their debt ceiling limit. And a lot of countries around the world are starting to change the way they function because of that. So Bitcoin, the narrative around that changes. So as an individual investor, it's not a straightforward allocate 10 or 20% and ride speculation. It's about think about the impact this will have over the next 10 or 20 years.
But Peter, my issue with any cryptocurrency is how do you value it? How do you know it's fairly valued, overvalued, undervalued?
It's the same way around the paper currency that we hold. I mean, I'm living in Australia and I earn and spend Australian dollars. I have no idea how to value that against the US dollar. I look at a chart and the market tends to trade it. I don't know if it should be at 65, 70 or 80 cents, right? I mean, there's interest rate differential.
But that's not necessarily the case because when you look at currencies, it is backed by a country's economy and you can see trade flows, you can see inflows into stock markets, capital inflows, you can get a gauge. But how do you do that with cryptocurrencies?
Look, if you don't believe in the cryptocurrencies or you can't value them or you can't form an investment basis, then I'd actually stay away from them. It's not for everybody. But if you do, for example, believe in the innovation that's happening in the Ethereum space, then you can go and have a look at the projects. You can go and have a look at the use cases that are emerging. You can go and have a look at banking, for example, and see the big inefficiencies, particularly in business banking. If you go and have a look at the UK, a lot of the fintechs that were the craze 5 or 10 years ago are very vulnerable now. A lot of fintech players have actually shrunk or are leaving the market. So if you don't get it, if you don't believe in it, it's still too early and you'd want to stay away. But there are ways to actually form views around, what's happening.
All right. Thank you for your time. That was Peter Esho, co-founder of Wealthy, ending the conversation, telling us that cryptocurrencies, there are ways to value it, but clearly it's not for everybody. If you're not comfortable with it,